Okay, Kate, do you have another speaker for me?
Yeah, I do. We've got James Schultz, Dr. Jim, from Tasty Trade here with us.
Yes, I
Oh,
am. I'm here. I'm here, John. I'm here, Kate. Should
great.
I go ahead and start my video?
Yeah, why don't you put your PowerPoint up on the uh, on the page so we can see it.
Yeah, let me go ahead and do that. So let me bring this up really quick. It's right here. So there we
Or
go.
hedge your portfolio from market drops.
You know, it seems a little timely there, John. It seems
I
like,
would say as long as
it-
the market drop doesn't end in the next 2 hours or so. Yeah,
I mean, it would have been nice to know all these things in January, right? Or maybe December of last year, I guess would have been a little bit better. But
yeah.
hey, better late than
A
never.
2020 hindsight. What can I say?
Yeah, that's exactly right.
Okay, let me just give you a quick introduction. Dr. James Schultz is the host of his daily flagship show, From Theory to Practice, where he explains theoretical trading concepts and provides a practical application of those concepts to a trading portfolio. He has also led various research series such as Skinny on Options, Abstract Applications, and Trade Logic Unlocked, and has tapped into his teaching roots on Where Do I Start Options 101 and Options Crash Course. Before joining Tasty Trade in 2016, Dr. Jim was a finance professor at Winthrop University, where he taught courses including Principles of Finance, Investments, and Financial Policy Management. Dr. Jim has acted as a motivational speaker and physique coach. Oh, I could use one of those. In his role as the CEO of Fitness and Your Finances. The organization aimed to help people get their lives on track and improve their wealth and physical health. So, Dr. James, where are you broadcasting from today?
So I'm actually broadcasting from St. Petersburg, Florida.
Lovely
And
place.
so, yeah,
Big time.
one of the silver linings of the pandemic was at Tasty Trade, we all pretty much went remote most of the time. So I was in Chicago for 5 years, but then I just basically told Tom, I'm like, hey, man, I'm like, I can't handle these Chicago winters anymore. And so we worked it out. And so now I'm down in St. Pete and we love it down here.
Yeah, I moved my whole global business to Lake Tahoe, Nevada.
hmm
All right.
Another beautiful place.
You have until 5 minutes before the hour. I'm going to go ahead and mute myself, and you have the floor.
Okay, terrific. Thanks so much there, John. Yeah, guys. So, I'm really excited to be with y'all today, like very, very excited. And I really want to give you guys something extremely practical. I want to give you guys something very tangible that you can use today. Like you can use some of the things we're going to talk about, for the next couple of minutes. You can begin to use these things today. And it is kind of serendipitous in a way, because we do have the FOMC meeting at 2 o'clock and nobody knows what's going to happen. Like, sure, the Fed might raise 75, they might raise 50, they might even go for the gusto and go 100. Like nobody really knows what's going to happen. There's of course, census and consensus and all those things, but we don't know what's going to happen. And even more than that, we don't know how the market's going to react to whatever's going to happen. The market may love 75. It may not love 75. It may really want 100. It may only want 50, all these things that we deal with as traders every single day, of course. And so, some of the things we're going to talk about here today, you guys can put these on in your portfolios immediately, after the presentation is over. And then I'll put my contact information up at the very end. You guys can always reach out to me, email, social media, whatever. And then, John, I don't know if we get done a little bit earlier, I'd love to answer any questions that might come through on the Zoom chat. And so I don't want to waste anybody's time today. If we get done early, then we get done early. And so I want to kind of get right into it. So 4 ways to hedge your portfolio from market drops. So right now, hedging is very hot. I mean, hedging is always kind of hot, of course, but right now it's very, very hot because, for the first time in, I don't know, 10, 11, 12 years, there's actually some significant choppiness in the marketplace. And I mean, it's more than choppiness. I mean, we're in a legitimate bear market now. I mean, the Nasdaq's been in a bear market for, several months, but even the S&P is bear market territory and the Dow is kind of creeping on the doorstep of bear market territory. So everybody's kind of thinking about, hey, how can I hedge my portfolio? How can I protect my portfolio? Most traders and investors are, long delta, they're positive delta. So they're thinking about, hey, market drops. How can I shield my capital and my wealth from these market drops? So I'm going to give you guys, a couple things to think about. So, the recent market drop has many traders and investors more interested than ever in protecting their portfolios. I'm going to give you guys 4 hedging strategies that you can use today. And I'm going to rank these from my least favorite to my most favorite. So this, of course, will give you a reason to stick around for the discussion here today. I'm not going to give you my best strategy until the very end. And so we're going to go from number 4, number 3, number 2, and then number 1. And so some of these you will be familiar with, of course. My least favorite strategy, this is probably it's very common. It's very popular in the hedging space. And I think it has some problems that we're going to get into here in a second. But yeah, so 4, 3, 2, 1, we'll do the hedging strategy. So, all right. So hedging strategy number 4, long puts. So this is a strategy, of course, that many, many investors like to use in their portfolios. Now, when you look at the way that I've built these slides today, if you see anything in a white box, that's effectively an advantage of this hedging strategy. If you see anything in a dark blue box, that is a cost, that is a drawback. Or the terminology that I always like to use on my show from Theory to Practice at Tasty Trade is, for every gimme, there's a gotcha. And so if you see something in a white box, that's a gimme. If you see something in a blue box or a dark blue box, that's a gotcha. And so as we work through these long puts, here are some things to think about. Many investors think that long puts are a good strategy to add to a long stock portfolio, and that is true to some degree, but these puts can be problematic. So first and foremost, I want to be fair. I want to be balanced here. Your long stock will be protected. And depending on how many puts you put in place, right, that's going to obviously dictate how much protection that you have effectively achieved. If the market sells off, long puts, they will absolutely offset losses from a long stock portfolio. That will absolutely happen 100% of the time. You will have a situation where the market goes down, your long puts, gain in value, your long puts, pick up, intrinsic value. They could potentially even pick up extrinsic value if there's a huge volatility spike, which there normally is when the market sells off. So these can be really, really good strategies. But so you got one gimme, and you got 2 gotchas. So that might kind of, give away how I feel about this strategy. The premiums on long puts, they ain't cheap. They're very, very expensive, right? Given the high velocity of the down moves that we've seen in the past, that we've seen just this year, that we just have seen historically with, the positive kurtosis in the marketplace, these outsized tails on both sides of the distribution. And then, of course, the negative skew where, normally big moves in the marketplace tend to happen to the downside, which is not to say they can't happen to the upside, because they happen to the upside too, as we saw with the COVID crash in 2020, where that rebound was quite aggressive to the upside. But most of the time, the big outlier moves, they do happen to the downside. Well, the puts and the pricing of those puts, they have all this baked into the cake, so to speak. Like, this is all already baked into the extrinsic value of those options. So if you're buying an out of the money put for protection on your portfolio, then you're going to see very, very, very high prices on that put. Like, you are going to see very, very, very expensive premiums on that put. And that's just the way that it is. Like, that's just the way that the market operates. And this all effectively transpired after the 1987 market crash, where volatility skew became a thing. These high velocity down moves became a thing, and it became something that people, started to put on their radars. So they began to realize, like, hey, wait a minute, I can buy these puts to protect my portfolio, but then the market's smarter than you, and it's smarter than me, and it's smarter than all of us. And so the market started to realize, all right, there's heavy demand for these puts. So what we're going to do is we're going to respond accordingly. I mean, just like any other market, in the whole global economy, whenever there's strong demand for your product, the price of that product is going to rise. This is just basic, like, Econ 101 type stuff. And so there's always strong demand for puts because people want this protection. And so the market responds accordingly. The market responds accordingly with higher prices and more expensive premiums. And so the question that I always have for people, and again, you can put this in place today. I'm not saying that this is not without its own gimmies. It has a gimme, at least one really strong gimme. If the market does sell off and you have a long put in place, you are going to get paid on that long put. So if you're looking at, I don't know what the market's doing this second, but 20 minutes ago, it was still pretty strong this morning heading into the FOMC meeting, which was a bit surprising. If you're thinking, hey, wait a minute, this doesn't feel right. I don't feel good about this, right? Hey, I don't blame you at all. You could put on a long put in SPY. You could put on a long put in QQQ. You could put on a long put in DIA. You could put on a long put in Twitter. You could do whatever you want to do. You could go out of the money. You could buy a long put. You could buy an at the money put if you want to. If the market goes down and you are correct directionally, then you are going to get paid on that. But here is the problem, maybe the biggest problem with this strategy. And here's what I always challenge people with. Is this going to be a repeatable strategy? Have you thought through the repeatability of this strategy? Markets want to go higher over time, right? Look at any historical chart. And I'm not talking about looking at the chart, looking for support, looking for resistance, looking for fib levels, doing all that kind of stuff. I'm just talking about just look at any historical chart over, a period of years and a period of decades. What do you see? You see the market wanting to go higher over time. And that makes sense for a number of reasons that we're not going to get into today. But when you think about just global growth and innovation and, creativity and all these things that just drive, the global growth engine, it makes perfect sense that the market would go higher over time. And so you have to think about the repeatability of this strategy. Now, some of you might be thinking, yeah, Jim, I don't care about the repeatability, man. Like, I just care about this Fed meeting. Like, I just care about the next 3 hours. Hey, I totally respect that. I completely respect that. I understand that. And I can appreciate that. And so maybe you do want to put some puts in place, for the FOMC meeting coming up here in the next couple of hours to protect your long delta. But I would encourage you, and I would strongly push you into thinking about the repeatability of everything that you do in the marketplace. Like, of course, there's a time to put things in place just as a one-off. There's a time to, YOLO some calls and YOLO some puts and whatever. But if you really want to do this consistently and successfully for more than a month or a quarter or a year or a couple of years, or maybe you're looking at this from, through the lens of a couple of decades, you got to think about that repeatability. And I just don't think that long puts are a repeatably profitable strategy. Our research at Tasty Trade has shown this is a losing strategy over time. This is a losing strategy over time. And again, as John and I were kind of joking about leading into the talk here today, the best time to have long puts would have been December. The best time to have long puts would have been January. Of course, that would have been incredible, right? But no, we didn't know that was going to happen. Nobody knew that this was going to happen. And it's kind of like, yeah, Jim, but it was so obvious. Like, yeah, Jim, but it was so clear. It's like, well, it's been pretty obvious and clear in the past, and the market's gone the complete other way. And so it's not as obvious and it's not as clear as we might think it is when we're looking through the rearview mirror, thinking, I should have seen that coming. I should have known better. Whatever the case may be. Yes, you put on a long put in January and you're still holding it today. Like, you're making just truckloads and truckloads of cash. But to be fair about this, if you bought a put in SPY at basically any time in 2009, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, and even 21, you were dead wrong. Like, of course, there was a couple blips on the radar. And of course, there were a couple of times when you could have cashed in some profitability. But by and large, right, you were fighting a losing battle. You were fighting an uphill battle there. So, again, it's a legitimate strategy. It does, have some merit to it. But I just want to make you all aware of the gimmies and the gotchas. Because one of the things I say on the show all the time is you have to know what you've signed up for. This is something that I see a lot of traders and investors, they don't quite have a firm handle on what they've exactly signed up for. And if you're buying puts as a way to protect your portfolio, if you're doing it here and there because you're concerned about a singular event, that's one thing. But if you're doing it as kind of a consistent strategy, I think it's going to serve as a drag on your overall profitability over time. And so this is hedging strategy number 4. This is my least favorite of the bunch, long puts. All right. So hedging strategy number 3. What about some VIX calls? So some of you might be thinking, all right, Jim, you kind of got me, you got me a little interested in this whole long put discussion. Maybe this isn't the best strategy. Well, what about some VIX calls? What about some straight up long calls in a volatility product like the VIX? Well, you could do this. But again, you can see the gimmies and the gotchas, they're tilted against you. You've got one gimme and two gotchas. Now, I'm not going to pretend that this is an exhaustive list, but from the way that I see these strategies, I think it's a fair discussion. Similar to long puts benefiting from the market dropping fast, long VIX calls would also benefit from big spikes in volatility. But you have to keep in mind a couple of things. Number one, the gimme. So let's be fair. If there is a huge spike in volatility, if there is a huge expansion in volatility, which we've seen a lot of at the beginning of this year, which, this is a bit of a tangent, so I don't want to go down this road too long, but, much like I do on From Theory to Practice, I'm not necessarily immune to a tangent or two. The VIX only being at 30, 35, 37, even given the big drops that we've seen this year, even given, NASDAQ down 30+%, SPY now down over 20%, Dow almost down 20%. It's like, man, I would have expected the VIX to be more like 40, 45, 48 at times, not persistently, of course, but to spike up a bit higher than it has. So that's been a bit peculiar to say the least. But if you have a VIX call on, if you buy a call in the VIX and volatility spikes, you are going to get paid. Again, let's be fair. Let's be very clear about this. Some of you might be thinking, heading into the FOMC meeting, you're like, yeah, I kind of want to, hedge my portfolio with some long volatility. Like I kind of want to hedge my portfolio with some long volatility exposure. Well, one of the ways that you could do that would be, straight into the volatility products themselves, and you could buy a call in the VIX. But much like our friend, the long put, these have expensive premiums too. Like these are very similar to long puts in that VIX calls are very, very, very expensive. You go at the money, you go out of the money, whatever. These are very, very, very costly to buy. And so when you go into the marketplace and you want to hedge, your portfolio by way of a long volatility position using something like a VIX call, this can be very, very expensive to buy. And secondly, it can be very, very expensive to hold, right? This is another thing that I think a lot of people maybe miss. If volatility were free, so let's just, let's kind of take a bit of a, just a bit of a sidebar from the slide here. Let's say that volatility was just free and, we could just hold long volatility positions in our portfolio for very little to no cost. Every single trader would do that. And I mean 100% of all traders would do that. Now, maybe not like your brand new traders, your beginner traders, they're just learning the ropes, all that stuff. Like I understand that. But once you get some exposure in the market, once you start to realize and understand how the market works, 100% of traders would do that. Because think about it. Why would you not do that? What is the thing that we are most exposed to? And it almost doesn't really matter, how you're playing the market, whether you're playing it long, whether you're playing it short, whatever the case may be. But if you're selling premium, if you're selling options to some degree, then you're going to be exposed to long volatility. You're going to be exposed to volatility expansion. You're going to be exposed to these outlier moves, these tail-like events that, again, oftentimes happen to the downside. And again, you don't even have to be a premium seller per se, which we are at Tasty Trade, but that's kind of a separate discussion. We're going to talk about that here in just a second. But even if you're just long delta in your portfolio, even if you're just by and large, long SPY, long QQQ, long IWM, whatever, you just have long market exposure, which most people do. What is the thing that's going to hurt you the most? Well, it's a huge drop, right? It's March of 2020, April of 2020, right? It's December of 2018. It's obviously October of 2008. It's the first 6 months of this year. These are the things that are going to hurt you the most. So if you think about what is the way that I can protect my portfolio from those big drops? Of course, we've already talked about long puts, but now we're just honing in on volatility. So now we're honing in specifically on volatility, because what do you notice when the market drops? Like, what do you typically notice when you have these huge outlier moves to the downside? Volatility goes crazy. Volatility spikes and expands quickly and rapidly. And that should make perfect sense to you when you think about what's happening in the world, right? Whenever the market drops, like crazily, it never does so, for no reason. Now, of course, we never know the reason that's going to be the catalyst to actually cause the drop, because the market can be pretty immune, more immune than we might think it can be during certain periods of time. But whenever we look at, October 2008, obviously the financial market collapse. Then you've got, the COVID crash of, March 2020, April 2020. That was pretty obvious too. But the COVID crash is an interesting thing because we knew about COVID in the US in, the first part of 2020, like in January, February, March, like we knew it was going to be a thing and we knew it was going to be a pretty serious thing. But what's really fascinating about the market is it continued to go higher. It continued to just march higher, all-time high after all-time high after all-time high. And it left everybody scratching their heads. And so you had the first 3 months of 2020 that didn't make any sense. And so then, if you bought VIX calls in the first 3 months of 2020, you got crushed, right? You were just throwing your money out the window. And so then April comes, right? And you've got your long VIX calls in place and you're like, all right, like it finally happened. The bottom fell out. Okay. If you had your VIX calls in place and you closed them out quickly, you would have gotten paid very, very well. But we all know what happened, about 2 weeks after the crash in April 2020. It skyrocketed higher, almost like a vertical line to the upside. We've never seen anything like it before. We may never see anything like it again in our lifetimes. I mean, I'm 41. I'm not going to see that again. There's no way. Like it was unbelievably unpredictable. Like it was so unbelievably just uncalled for. It was like, wow, man, like the market randomness and the market unpredictability really won the day when it came to the COVID crash and then the COVID rebound. And so this is all just to say that, if volatility didn't cost anything, we would all have it in our portfolios because it would just be a cheap way to hedge our portfolios. But that's not the case. So much like we see with long puts, volatility is very expensive to hold. We always like to say at Tasty Trade, like volatility is very expensive to inventory. You can't just buy it and toss it in the pantry and just forget about it. Like you can't just throw it in there with the pink Himalayan salt and the gluten-free breadcrumbs and just say, well, I think I'll need this at some point. Like, no, like it's going to be a significant drag, a significant cost on what you're trying to do. And so when it comes to profiting from VIX calls, and this is another reason why I don't really love this strategy, is your timing has to be pristine. Your timing has to be like perfect, man. You have to nail it to a T. The second gotcha here, and I've kind of alluded to this a little bit with the long push discussion, and then also kind of with, what's been going on with the market drifting higher over time and just looking at the uptrends historically and all those things. Volatility contraction. So 85% of the time, volatility is in a state of contraction. So this is one of the things that we hang our hat on over at Tasty Trade. This is one of the reasons why we sell premium. This is one of the reasons why we like the short side of the option contract, because there's just so much more opportunity on that side as we see it, simply because volatility contracts most of the time. Well, if I'm selling options, if I'm selling volatility and it's usually in a state of contraction, then that's going to work very well for me. That's going to be a huge benefit for me. Now, of course, that gimme itself is not without its own gotcha because, you are going to get torched from time to time, and you just have to size your positions accordingly to be able to handle that. We're going to talk about that here in the next couple of minutes. But if I'm buying VIX calls, if I'm long volatility, then, this 85% of the time that volatility is contracting, the 6 out of every 7 days, it basically works out to that volatility is actually on, the downswing. That just becomes kind of a slow bleed. That just becomes kind of like this slow drain that where I'm really fighting this uphill battle again, where unless I've timed it perfectly, I'm just going to see my premium in my VIX calls just, dwindle down and dwindle down and dwindle down. And so it's not going to work out as, easily and nicely and cleanly as I might like it to. And so in order to be effective with a VIX call strategy, you have to time these really, really well. And again, kind of, like I referenced when I talked about the COVID situation in 2020, because it's such a good example. It's not always so obvious. It's not always so obvious what's actually going to be the catalyst to cause volatility to spike through the roof. Because again, I mean, if you would have told me that we knew about COVID in January or February of 2020, I would have thought, and you told me the market was going to fall that year significantly, I would have said, well, it's going to happen, early in the year. It's not going to wait till April. It's not going to wait till the end of March. That doesn't make any sense. But again, the market is so random and unpredictable, and we don't really know what's the driving force in any given moment. This can just be really, really, really difficult to time perfectly. But again, if you want to put this on for a singular event because you're like, hey, I'm willing to spend a couple bucks on a VIX call or two to hedge some of my portfolio. I don't necessarily have a problem with that, but I would continue to encourage you guys to think about the repeatability here and think about, using these things over and over and over again. Because if you're tuning into a Mad Trader, virtual conference, like if you're here, you're listening to this talk, you heard the previous speaker, you're lined up for the next speaker, like you're serious about this, man. Like you don't stumble into a conference like this as just kind of like a, just a weekend warrior when it comes to trading and investing. Like you're obviously taking this quite seriously. And so I would just assume that you want to do this for a long time. Well, if you want to do this for a long time, I don't know that long puts are the answer. And I don't know that VIX calls are the answer. So now some of you might be thinking, all right, Jim, you're like halfway through, man, and you haven't given me any answers. You've just given me a lot of problems. You've just given me a lot of things not to do. So can you give me a couple of things that I can do? Well, let's get to hedging strategy number 2 and hedging strategy number 1. So these are things that I think are a better fit and will give you more effectiveness from a hedging standpoint. So hedging strategy number 2, short delta. So holding short delta, especially static short delta, and I'll explain what that means here in a second, can serve as a very effective hedging tool for short premium. Now, short delta, again, most people are long delta. So most people, and I would say, we've got 175 people watching the program here today. Thank you guys so much for joining me. I'm so humbled that so many people are taking time out of their FOMC Wednesday afternoon to spend with me and John and Kate and everybody over here. It's really, really awesome. I'm going to assume that 150 of you are long delta, 160 of you are long delta. It might even be a higher number than that. It's pretty unusual for people to be overall bearish on the marketplace. It does happen. And at Tasty Trade, we kind of highlight the benefits of doing that, actually. And we'll talk about that a little bit here on this slide. But most people are going to be long delta. They're going to have positive exposure to the marketplace. They want the market to go higher over time. And that makes sense. I'm actually bullish myself. I'm kind of a perma bull, as some might say. And so I see the market through the lens of the upside too. So I can absolutely relate to, the 150, 160, 170 of you that might be playing the market to the long side. Well, given that long exposure to the marketplace, having some short delta in your portfolio, especially static short delta is like short stock or short futures. That's different from dynamic short delta, which is like a short delta options position. So like a short call or like a skewed strangle or like a short call spread or something like that. That's still short delta, but that delta is going to change as the market moves. And ironically enough, when you have dynamic short delta, like a short call, skewed short strangle, or a short call spread, these are great examples. When the market starts to drop and you actually need that delta to help you, it actually becomes less and less bearish. It actually becomes less and less short. And so that's just a feature of being, what is called negative gamma when you sell options. And that's a whole separate thing. I don't want to get into that. But when you're static short delta, you effectively get a 1-for-1 move with whatever the underlying, product might do, SPY, E-mini S&P futures, NASDAQ futures, whatever you might be using, bond futures, gold futures, whatever you might be using. You're going to get a 1-for-1 move. Well, that's really nice if you want a hedge and you're like, hey, I don't want to mess with dynamic short delta. I want a very clean payoff if the market does go down. Okay. When it comes to gimmies and gotchas here, you can see that we're in a little bit more of a favorable situation, at least as I've painted it here this afternoon. You have 2 gimmies and you have 1 gotcha. Well, first of all, when volatility goes up, prices normally go down. Now, this is a gimme that is specifically for traders that like to have some short premium exposure in their portfolios. Now, I know, we've got almost 200 people watching right now. You guys are coming from all different types of, walks of life in the world of trading. Like some of you might be technical traders. Some of you might be fundamental traders. Some of you might be, quantitative traders. Some of you might like buying options. Some of you might like selling options. Like there's going to be a jambalaya, so to speak, of different personalities and characteristics and ways of doing things. This gimme is specifically tailored for the premium sellers out there. This gimme is very specifically aimed at those of you out there that see the opportunity in selling options and you see the opportunity in selling premium in the marketplace. When volatility expands, when you sell options, again, as we saw on the previous slide, the market likes to contract from a volatility standpoint. If I sell options, this is a good thing for me, right? This helps me because it sends option prices lower, which is good because I sold them, up high and I want to buy them back down low. That's the basic idea of selling options. It's basically the reverse of what we all know to be the secret to the stock market, which is buy low and sell high. Like we're doing the same thing. We're just selling it high first, hoping to buy it back low later on. When you are short premium though, volatility contraction helps you. That's absolutely true. Volatility contraction benefits you. That's absolutely true. So the reverse must also be true. If volatility goes up, if volatility expands, if the VIX explodes and it goes from 20 to 45, like that's going to really hurt you. Like that's going to really be a drag on your position's P&L, at least temporarily, if not permanently, depending on, the strike prices that you've selected and things of that nature. But if you have short delta in place, this can actually serve to soften that blow. Like this can actually serve as a hedge against that short premium. Because, one of the reliable relationships that exists in the marketplace is this whole idea of market prices and market volatility moving inversely of one another. Most of the time, and I mean like most of the time, like 90, 95, 97% of the time, if not more than that, when market prices are going higher, volatility is going lower. When market prices are going lower, volatility is going higher. So you have this inverse relationship. Now, it's not 100%. This isn't a one-for-one reliably relationship because, these are their own products. These are their own metrics and measurements in the marketplace. And so there's no guarantee that this is going to happen, but man, it is extremely reliable. So if I think about that and I think about, okay, I have this short premium portfolio. Maybe my portfolio is all short premium, just only short options. Maybe it's a mix of I have some long stock and I have some short options. That's probably the most classic setup that most traders and even tasty traders are going to utilize in their portfolio because you're able to kind of, capitalize on the benefits of the market moving higher over time and the opportunities of short premium and all those different things. If I'm short premium in my portfolio and market prices drop, volatility is most likely going to be moving higher. And we've basically seen that at the beginning of this year. I mean, yes, I'm a little bit surprised that the VIX hasn't spiked up to higher levels, but it doesn't change the fact that the VIX is still higher than it has been in quite some time. It's consistently higher than it has been in quite some time. I mean, for, 2017, 18, 19, like, I don't know if y'all remember, but we were trading VIX at like 9, right? VIX at like 10. It was like, I don't even know why I should go into the office today. Like nothing's going to move. Like nothing's going to happen. Nothing's going to change. I mean, it was pretty crazy, man. VIX in single digits was some wild times. Well, now, VIX at 25, VIX at 28, VIX at 33, like this is kind of like normal. This is kind of like everyday behavior. And so, the markets have certainly changed into a slightly higher volatility environment. So the market going down at the beginning of this year and volatility going up at the beginning of this year, it makes perfect sense, right? It makes perfect sense because of this reliably inverse relationship. And so now you can kind of put the pieces together a little bit, right? And we're still just on this first gimme. If I have a little bit of short delta in place, and you don't even have to be like net short delta in your portfolio, you can still be net long delta in your portfolio. I mean, you could be net short delta if you want to, and we'll talk about that with the second gimme here in just a second. But if you just want to have a piece, a portion of your portfolio, then, you could have some short E-mini S&P futures. You could have some short NASDAQ futures. Or if you don't like trading futures, which I know a lot of traders don't like to mess with futures, and I totally understand and respect that, you can just have some short SPY stock. You can just have some short QQQ stock, right? So these are things you can do to just take off a portion of your portfolio that just hedges a little bit of, the exposure that you have to the upside. If you have that in place, right, put the pieces together. The market goes down, volatility expands, your short premium is hurt. Your short premium is actually, going down. The P&L is moving negative because of that volatility expansion, but you have short delta in place that is helping to soften that blow. It is helping to kind of take the edge off of those losses that you're experiencing from that short premium. Now, naturally, if I was listening to the program today and I was watching the presentation today, here is the question that would be in my head right now. All right, Jim, it sounds interesting, but here's what I need to know. How much short delta should I carry? how much short delta should I carry? Is there a way for me to figure out how much short delta I should carry? And the answer to that question is in the second gimme. The answer to that question is in kind of the second box. So again, this is through the lens, this is from the vantage point of a premium seller. And so now we're kind of transitioning into things that are going to be a little bit more applicable to those of you out there that have some interest or some exposure to selling premium in your portfolio. If you're selling premium in your portfolio, then you are naturally going to be positive theta. You're going to be positive theta, right? Time decay of options is going to be working for you. The simple passage of time is going to be benefiting you. You're going to be profiting from just the natural decay of option prices. This is, if I had to boil down the number one thing that we like to take advantage of at Tasty Trade, it is this. Yes, volatility helps a lot. Yes, high implied volatility rank helps a lot. Like, yes, short delta is a piece to the puzzle, all these things. But the number one thing that we like to take advantage of is positive theta. All right, I have some positive theta in my portfolio, but again, that's only going to come from short premium. You can't buy options and get positive theta. That doesn't really make sense. It's a bit of a mutually exclusive situation. So if I'm going to generate positive theta from selling premium, that short premium is going to be exposed, right? It's going to be exposed to volatility expansions. It's going to potentially be exposed to market drops if I'm also long delta, right? All the things we've already talked about. So you're thinking, Ari, I'm kind of interested. How much short delta should I carry? Now, this ratio, it's going to be a little bit more applicable if you want to hold net short delta in your portfolio. So that would mean, to be very clear, that you are actually not long the market. You are short the market. So you are not playing the market to the upside. You are playing the market to the downside. Now, some of you, of the 175 people that are watching, like your heads just started spinning. You're like, whoa, I didn't even know that we could do that. I didn't even know that we were supposed to do that. I certainly don't think that I should do that. And now you're going to talk about this as a possible, option for me? Absolutely. And we talk about this a lot at Tasty Trade. And of course, in an hour-long presentation or 45-minute long presentation, there is no way that I could possibly unpack all of that here. But it definitely is an option, and it does have benefits associated with it. One of those is it actually shows you the way that we kind of position it at Tasty Trade, and through the research that we've done and through the mathematical models and the quantitative principles that I talk about this on my show From Theory to Practice all the time. When we've looked at these things and we've studied these things and we've kind of dissected these things, what we have found is you have a certain amount of theta in your portfolio. $50 a day, $100 a day, $15 a day, $1,000 a day. It all depends on your account size and experience level and risk tolerance and a bunch of other things. But once you have that theta in place, once you have that number, it really unlocks the doorway to understanding how much short delta you should carry. Because if you are a Tasty trader and you are a premium seller, most likely you want the short premium in your portfolio to be the star of the show. Like, you want the short premium in your portfolio to be calling the shots. You don't necessarily want the short delta or even the long delta for that matter to be calling the shots, right? Like, again, like we wholeheartedly believe at Tasty Trade, the markets are random, they're unpredictable, and they're really, really hard to pin down. And again, COVID from early 2020 is a great example of that. And there's, of course, other examples of that. I mean, the 12-year bull market run was also pretty unpredictable and quite random in its own right. But when you think about, holding short delta and you think about how much short delta to hold, a great ratio to target is a 1 to 2 level. So for example, if I'm positive 100 theta in my portfolio, then I would look to carry about 50 short delta. So that is how you would apply this ratio. If I'm carrying, 500 positive theta in my portfolio, then I'm going to look to carry about 250 short delta. Like short delta as beta weighted to the SPY. So like short delta in like some overall market index, like SPY, QQQ, whatever. This gives me a really nice reference point for it's like, all right, now I understand what the appropriate level of, directional exposure to the downside to protect my portfolio might be given the amount of short premium exposure that I have. And so this is really, really nice because again, I caught the tail end of the previous speaker's presentation and I thought the last 5 or 7 minutes were really, really great. Like I thought they were terrific. And I think he was talking about like a wedge that had just happened, in the last couple of days. Like that's really terrific. And I thought, wow, this is a really, really valuable discussion. I kind of wish I had tuned in a bit earlier to hear what else he had to say. But that doesn't change the fact that predicting direction in the marketplace is extremely difficult. It doesn't change the fact that, knowing when the perfect time to enter and exit the marketplace, like that is extremely difficult. That is a very, very slippery thing to pin down. And so when you have this metric in place, you move away from the technical side of trading, at least for the moment. You move away from the fundamental side of trading, at least for the moment. And you just hone in on the quantitative side of trading, the quantitative side of the markets, right? This quantitative, kind of basis that exists in the world of options. You're like, all right, man, I've got all this positive theta. Let me get on half that amount in delta. And it's just so effective at giving you guidance, in terms of entry and exit that doesn't have anything to do with, technical analysis or fundamental analysis or anything of that sort. It's its own animal, altogether. And so I find that to be extremely advantageous for those of you that want to carry more of a short bias in the marketplace.
Yes, sir.
Lastly, I'm sorry.
Yeah. I sent you a text a couple minutes ago. Yeah, I'm back.
Oh, I think that, okay. So when it comes to the gimmies, we've got volatility up, prices down. We've got targeting a 1-to-2 delta theta ratio. Okay. What is the gotcha? Well, you could probably figure this out, if for no other reason than we've been on this slide now for 8 minutes, and all my overachievers out there, you've already digested all this information. But give me 2 minutes to go ahead and go through it myself. You're fighting against drift. Like if you're going to carry short delta, whether it be as some portion of your portfolio or whether it be, writ large in your portfolio, you want to have a bearish bias, you're fighting against drift. You're fighting against the natural trend of the markets going higher. You're fighting against, the innovation and the growth and the creativity that has existed for 275 years or however long it's been, right? I mean, look at any historical chart of the markets and you just see an upward trajectory. Sometimes it goes up faster than other times, but over, any long-term time horizon, you're fighting against the natural drift. It's kind of like, I've got 3 small children. I've got my oldest daughter is 7, my son is 5, and the baby, she's 2, right? And so I'm very, well aware of the children's games that I played as a child because I'm playing them all again with my children. And so it's like, we've all played Whirlpool, right? Like we've all played Whirlpool. It's super fun. Everybody has a good time. Like it's a slam dunk. Like it's a never miss, right? You're in the pool, you're doing Whirlpool, everybody's going around and everybody's having a good time. Almost like clockwork. There's always got to be just that one stick in the mud, just that one little Yahoo that has to go the other direction, right? He has to start going the other way. She has to start going the other way. And then all of a sudden, everything starts to change. Well, imagine if you were that little whippersnapper going the other direction. What are you going to feel? You're going to feel a lot of friction. You're going to feel a lot of resistance, right? You're going to feel a lot of, a lot of momentum coming against you, at least in the beginning, because you are going against the tide. It's no different here. If you're going to hold short delta, again, I'm not saying it's right or wrong. I'm not saying it's better or worse. I'm just saying, these are the gimmies and these are the gotchas. My job today is really just to present you guys with the pros and the cons of all these different hedging strategies. There is no perfect hedging strategy. They all have costs. They all have gotchas. Right? If you ever hear anyone try to tell you or sell you on this, system or whatever being the perfect system, I would run, man. I would run because that doesn't exist. Right? It absolutely does not exist. Everything has a cost. Everything has an opportunity cost to it. And we're going to talk about that a little bit more here in just a second. But just understand right now that if you hold short delta, you're fighting against that drift, right? You are the whippersnapper in the pool that, wants to ruin the game of Whirlpool for everybody else. So hedging strategy number 1. And then I don't know, John, I think we'll probably get done a couple minutes early. So if there's any questions in the Zoom chat, I'd love to answer those questions. But hedging strategy number 1. Small size. This is it. It's not even close. It's not even close. This is the best hedging strategy that you could apply in your portfolio right now. And again, you could use any one of these 4 strategies at some time between now and the FOMC meeting in 2 hours, right? You could buy puts, of course. You could buy VIX calls, of course. You could put on some short delta, of course. Well, you could also shrink your size. If you're already small, then kudos to you. But if you're maybe not so small, you can maybe shrink that size a little bit. You can maybe take off a little bit of heat, maybe take off a little bit of size going into this FOMC meeting. You know, if you're a little bit nervous, if you're a little bit unsure, you can always put it back on, right? You can always get back into the trade. The markets will be there tomorrow. The markets will be there Friday, right? And so you can always get back into these trades. Small position sizing gives you the most effective hedge on your portfolio, and it does so more organically than any other approach. And so the first gimme with small size is it gives you freedom and it gives you flexibility to do whatever you want to do. And I really, really cannot communicate to you how important this is and how valuable this is. And for, you know, people that are watching today that are, you know, smaller in their position sizing in their portfolios, you know exactly what I'm talking about. You know exactly what I'm talking about, where you're not sweating out the FOMC meeting necessarily. You're not sweating out, you know, Netflix earnings, right? You're not sweating out, you know, when, you know, President Biden is going to talk, and when President Trump is going to talk, and when President whoever is going to talk. You're not sweating these things out. You're not sweating these things out because your position size was controlled on entry. And so you have freedom and flexibility to effectively take those positions and do whatever you want with them. You can take those positions and just move in whatever direction you want to. You can layer on other hedging strategies if you want to. You can buy puts, you can buy VIX calls, right? You can add a little short delta. You can do some other thing that we didn't even talk about, you know, here today. But none of them are required. Because your position sizing is controlled so well on entry, you won't feel any pressure. You won't feel any urgency. You won't feel like, man, like my whole portfolio kind of hinges on what, you know, Uncle Jerome has to say in these next couple hours. That is not a good situation to be in. Hey, I've been there. I'm speaking from experience, right? And I can say, just as a bit of a side note, I've been trading now. I started trading in 2007. So I was a second year PhD student, and so I'm about 15 years in terms of my experience in the marketplace. I can say with 100% certainty that every single mistake that I've made, every single bad trade that I've made, and there've been some big ones and some bad ones, every single expensive mistake that I've made, every single boneheaded move that I've made in the marketplace, there's one common denominator. Some of them were long, some of them were short, some of them were options, some of them were stocks, some of them were futures, some of them were technical analysis, some of them were fundamental analysis. They all have a different storyline to some degree. There's one player that showed up in every single plot. Too big, too much size, too over leveraged, right? Thinking I knew what was going to happen next with 100% certainty. I don't think that can be known. I don't think that can be known. And so every single problem I've had can be traced back to large size. And I'd be willing to bet that, again, you know, of the almost 200 people that are watching, I'm willing to bet that a lot of you share the same story, because I've just communicated with so many traders over the years. And this is the thing that is the hang up that causes them to have to emotionally pivot away from whatever it is they might be doing. So when you're small with your size, it gives you the freedom, it gives you the flexibility. Moving on to the second gimme. It's going to allow you to follow the mechanics that you have put in place for yourself. Now at Tasty Trade, we have a whole set of mechanics. We talk about it. I talk about it on my show. Tom and Tony talk about it on their shows. Liz and Jenny talk about it on their shows. Like everybody, you know, we all talk about the same 5, 6, 7 mechanics. And again, it's way too much for me to get into that here, since we only have about, 10 minutes to go. So definitely check out Tasty Trade. Check out all the shows. I'm a little biased to From Theory to Practice, but any show that you might land on is going to be a great show, and it's going to be a good show. When you are small, when your position sizing is in check, you're going to be able to follow the mechanics objectively. You're going to be able to follow the mechanics with little to no emotion. Well, let's say little emotion. I think no emotion. I think emotionless trading is just, it's a pipe dream. I think it's an infeasible solution for all my economists out there, because we're not robots, man. We're not algos. Like, we're human beings. So we have emotions, we have emotions, we have, fear and greed and hope and all these different things. And so, but if you can minimize that to where it's not influencing your trading too heavily, that's a huge win in my book. That's a huge win in my book. And so when you're small, you've got freedom, you've got flexibility. When you're small, you're able to follow the mechanics more objectively. That's a huge, huge plus. Now, what is the gotcha? Because there's always a gotcha. I can assure you that whenever you think that you have a system that is only gimmies and no gotchas, you are not correct. There is a gotcha there somewhere. You just have to figure out what it is and where it exists. In this situation, I think the biggest gotcha is this. It's opportunity cost. The biggest gotcha is this. And today is a great example, right? So we've got FOMC coming up in a couple of hours. And, a lot of people have their opinions. A lot of people have their projections. A lot of people have their, prognostications about what's going to happen. And more importantly, how the market is going to react to whatever happens. If you are correct in your own personal prognostication, right? Like, let's say, just for example, that you think, all right, I do think they're going to raise 75 basis points. And I do think the market's actually going to like that. And it's going to rally really hard, whether that rally is because of, fundamentals or technicals, or it's just a short squeeze, or for whatever reason, right? You think the market's going to take off. You think, even the S&Ps could be up 100. You think NASDAQ could be up 400, whatever, right? If you are correct, you're going to wish that you were much bigger than you were. You're going to wish you had never seen this slide that I just presented. You're going to wish that you had clicked off when we went through the first 2 or 3 hedging strategies, because you're like, man, I'm going to size up. I'm going to tap into some leverage, and I'm going for it, man. Like, it's time for that YOLO call that Jim mentioned, 25 minutes ago. Like, now's the time. Well, yeah, if you're correct, we always feel that way. Like, again, this is almost a silly thing to say, but it's important to mention here because it's very relevant. We always feel like, I knew that was going to happen. I knew the market was going to rally. I knew the market was going to drop. I knew the market was going to fill in the blank. Of course you did. Of course you did, looking through the rearview mirror, right? But we have to remember, again, for all my economists out there, we're always dealing with imperfect information. We're always dealing with incomplete information. We don't know how the market's going to react. We don't know what's going to happen. One of the things that we say at Tasty Trade all the time is you can't trade the market that you want. You have to trade the market that you have. And so, sure, I wish I was right all the time. I wish I was right 85% of the time. Right? That would be terrific. But that's just not the reality. That's just not the market that we have. That's just not the situation that we find ourselves in. And so when you're in these situations, you have to, again, think about the repeatability. Think about the unknown nature of what's going to happen in the marketplace. Think about the randomness. Think about the unpredictability, and respect it, man. Like, appreciate it. And so because of that, sizing down on entry just makes so much sense. It just makes so much sense. And, after the fact, you're always going to feel like, man, I wish I was a lot larger, but give yourself a little bit of grace, man. Give yourself a little bit of, I didn't know what was going to happen. Like, sure, I was right. And I'm really glad that I was right. And my portfolio is happy that I was right. But in reality, I didn't really know for sure that was going to happen. Again, by all means, put the probabilities on your side, like, come at this from a quantitative angle, like, do all these different statistical things that maybe give you, a little bit of an advantage in the marketplace, let's say, a little bit of an edge in the marketplace, let's say. I don't know if it is an edge per se, but from a high probability standpoint, I think it does definitely have some merit to it. Like, do all those different things. We talk about all these things at Tasty Trade all the time, but still understand and appreciate that the market might do something that you never saw coming. And if there is any better example than COVID crash and rebound of 2020, I don't know what it is, because that is just such a great example. And it's something that we can all remember because it's very recent. And it's like, yeah, man, it was crazy. I mean, for that week in March and April, it was limit down, then limit up, limit down, then limit up. I mean, it was really, really wild when it, you would have expected it to just be limit down, limit down, limit down, but it wasn't. It was limit down, limit up, limit down, limit up. And so it's just really, really wild and really, really crazy. So those are my 4 hedging strategies, from least favorite to most favorite. And then lastly, I just want to give you guys my contact information. We might have a second here for questions there, John. I'm not sure, but if we don't, and if I can't get to your question, guys, please reach out to me, man. You can always email me. My email is right there on the screen. It's just jschultz@tastytrade.com. And then, my social media, I'm just at jschultzf3 pretty much across the board. I'm probably most active on Twitter and Instagram. And so if you want to reach out to me there, if you're on there too, then let's connect, man. Let's connect. Let's talk trading. Let's talk, let's talk squats and deadlifts. Let's talk about whatever you want to talk about. And so I really hope that today was helpful for you guys. And I really hope that this gave you guys some different things to think about when it comes to hedging your portfolio, whether it be today or, in the future. And yeah. So John, I don't know. Do we have any questions that came in, or do you want to just kind of move to the next speaker?
Have your chat box open?
Yeah. Okay.
Okay. Look at the bottom of your chat box. You have a couple.
Oh
questions
yeah. The one
here.
from Mary Jane.
Yeah.
Yeah, I see it. So great question, Mary Jane. Let's get into this. So Dr. Jim, for strategy number 2, could you use a put debit spread to counter the problem of increasing volatility, this would be a winner in a large downtrend, even if volatility rises. Limitation is that it caps how much profit that this hedge to the downside can provide. So Mary Jane, so let's go back to this. It's a great question, Mary Jane. Excellent question. Let's go back to
Jane
this.
knows what she's talking about.
Oh, no question. So Mary Jane might even be a tasty trader, actually, because we talk about this a little bit at Tasty Trade. So rather than buying puts outright, where you have, the naked long premium that's just going to get chewed to pieces from negative theta and all that decay in the options, we would much prefer to spread this thing off. So Mary Jane is absolutely 100% correct. If I wanted to do some type of long put strategy that, could benefit from a market drop, I wouldn't do a long put. I would do a long put spread. So, like, for example, you've got SPY at, whatever it's at, 300 or whatever. I don't know where it is in this moment exactly. But let's say I wanted to buy, a 280 put, right? So if I buy a 280 put, then, I could sell a 270 put, right? I could sell a 270 put. I might be thinking of the NASDAQ. So if I buy an out of the money put, let's just keep this a little bit simpler, because sometimes the NASDAQ, SPY, they kind of run together in my head. If I buy an out of the money put, I can sell a further out of the money put, maybe 10 points lower or 5 points lower, just as Mary Jane kind of, referenced there. You can do that. It's going to really help to slow down the negative theta from that long put. But, and this is why I love Mary Jane's question, she even highlighted the gotcha inside of her question, right? The gotcha is you are going to have some downside exposure. Yes. If the market does drop, it is going to help you. Yes. But your gains are going to be capped. They're going to be capped right at that short strike. So wherever you decide to sell that put to offset that negative theta from the long put, that's where you're choosing to cap your upside, so to speak, from a drop in the market. So that's a great question there, Mary Jane. Really, really good question.
Okay, and just to remind everyone, the link to the dedicated sales page here is on the right. It says here trendlinebreak.com. And let's see, any more questions? No. So that is about it. Thank you very much for giving your presentation today, and look forward to working with you again in the future.
Yeah, thanks a lot, John. I appreciate it.